The tone between Washington and Ottawa has shifted so dramatically over the past 48 hours that veteran diplomats are privately describing it not as a disagreement, but as a structural rupture, a moment when assumptions that governed North American stability for generations suddenly stopped applying. For decades, the United States and Canada operated on a kind of strategic autopilot, their border the longest undefended line in the world, their supply chains intertwined so tightly that political friction rarely translated into economic shock. That era now looks fragile. What unfolded began with a familiar instrument of modern power, a public ultimatum delivered digitally and amplified instantly. Frustrated with the pace of negotiations surrounding the review of the United States-Mexico-Canada agreement, President Donald Trump issued a demand that Ottawa dismantle its digital services tax and grant sweeping new access to American dairy producers, warning that failure to comply within 24 hours would trigger a blanket 25% tariff on Canadian automobiles and auto parts entering the United States. In previous chapters of bilateral tension, such pressure might have prompted quiet diplomatic outreach, carefully worded statements about shared values, or last-minute concessions designed to preserve calm. Instead, Prime Minister Mark Carney responded with a direct and unambiguous rejection. Standing before reporters in Ottawa, composed and deliberate, he declined to counteroffer or request additional time, and stated that Canada would not negotiate under threat, adding that if Washington imposed automotive tariffs, Ottawa would activate targeted retaliatory measures focused on American energy exports and intellectual property protections. Markets reacted before political narratives could solidify. Shares of major U.S. automakers slid sharply as investors recalculated exposure to a cross-border manufacturing system in which components often traverse the frontier multiple times before final assembly, meaning a tariff would compound costs at each crossing and reverberate through factories in Michigan, Ohio, and beyond. Currency traders, meanwhile, did not punish the Canadian dollar as many in Washington appeared to expect. Instead, it stabilized, signaling that capital was not fleeing northward in panic. Energy futures ticked higher on speculation that even modest Canadian constraints on crude exports could disrupt refineries configured for heavy blends sourced predominantly from Alberta. Beneath the political theater lies arithmetic that both sides understand. Roughly 60% of U.S. crude oil imports originate in Canada, and the Great Lakes Industrial Corridor functions as a single integrated production ecosystem rather than two national silos. Executives inside Detroit manufacturing hubs reportedly scrambled to accelerate shipments before potential deadlines, aware that assembly lines cannot operate on patriotic rhetoric alone. At the same time, Carney leveraged relationships cultivated during his tenure at the Bank of Canada and the Bank of England, engaging counterparts in Brussels, London, and Tokyo to coordinate messaging about supply chain stability and rules-based trade, reinforcing an image of Canada as a predictable actor amid volatility. The contrast in styles has become part of the story, one leader deploying shock as leverage, the other projecting technocratic steadiness. Yet beyond optics, the strategic dilemma facing the White House is concrete. If tariffs proceed, consumer prices in the United States would likely rise quickly. Vehicles, replacement parts, transportation costs, and potentially gasoline, placing pressure on households and on political constituencies central to upcoming elections. If the administration retreats, it risks appearing to have issued an ultimatum it could not enforce. Advisors reportedly debate the economic versus political costs, underscoring the tension between short-term signaling and long-term impact. Corporate voices have entered the conversation as well. Business groups warn that unraveling continental trade flows could inflict damage disproportionate to any negotiating gain. Governors in border states, whose economies are deeply integrated with Canadian partners, have largely avoided inflammatory rhetoric, a silence that itself speaks to concern. For Canada, the calculus is equally complex. The United States remains its dominant trading partner, and any sustained disruption would carry domestic consequences. However, by signaling readiness to impose precise countermeasures rather than broad retaliation, Ottawa appears to be targeting pressure points rather than initiating an indiscriminate trade war. Analysts describe this as a strategy of calibrated deterrence, raise the cost of escalation sufficiently to encourage reconsideration without collapsing the broader framework. The geopolitical implications extend further. If a country as closely aligned with Washington as Canada demonstrates willingness to resist public economic coercion, other allies may reassess how they negotiate disputes, potentially reshaping alliance dynamics that have long depended on American preponderance. Investors are watching not just tariff schedules, but trust, confidence that agreements will endure beyond a single news cycle. Three broad trajectories are now conceivable. One involves a contained standoff in which tariffs and countermeasures are imposed, markets absorb short-term pain, and political or corporate pressure eventually produces compromise. Another entails escalation, with additional sectors drawn into conflict and recession risks intensifying across the continent. A third envisions strategic diversification, as Canada accelerates trade arrangements with Europe and Asia, gradually reducing dependence on U.S. demand, an adjustment costly in the near term, but transformative over time. None of these outcomes restores the previous assumption that cross-border cooperation is automatic and immune to political shock. What has changed most fundamentally is the perception of inevitability. Stability once taken for granted now appears conditional. Whether this episode becomes a brief rupture or the beginning of structural decoupling will depend on decisions made in the coming days. Yet the immediate lesson is clear. In an era of instantaneous communication and tightly integrated economies, ultimatums reverberate faster than ever, and even long-standing partnerships can pivot abruptly when leverage meets resistance. What makes this moment especially consequential is not simply the exchange of threats, but the exposure of how deeply fused the two economies have become, because disentangling them is neither quick nor clean, and every lever pulled in Washington or Ottawa now reverberates through pension funds, factory payrolls, provincial budgets, and state tax receipts. Trade between the two countries exceeds hundreds of billions of dollars annually, but those aggregate numbers obscure a more important reality. The architecture of North American production was deliberately engineered over 3 decades to eliminate friction, to treat the continent as a single manufacturing platform capable of competing with Europe and East Asia. Auto parts, aerospace components, agricultural inputs, critical minerals, and refined fuels move back and forth with such frequency that imposing a tariff is less like erecting a wall and more like dropping sand into a gearbox already spinning at high speed. Economists note that even the anticipation of disruption can cause companies to delay orders, pause hiring, and widen profit margins as insurance against uncertainty, meaning the psychological impact of confrontation may begin biting before a single customs form changes. Inside boardrooms across Chicago, Toronto, Calgary, and New York, executives are running contingency models. How long inventories can sustain output, which suppliers can be replaced, whether transportation routes can be rerouted, and how quickly price increases can be passed to consumers without crushing demand. Financial markets, often caricatured as emotional, are in fact ruthlessly pragmatic. They price probability, and the probability now being assessed is not merely tariff implementation, but political durability. If leaders demonstrate willingness to weaponize economic interdependence during negotiations, investors must account for that precedent in every future cross-border calculation. That is why bond yields, currency spreads, and commodity futures have become a parallel referendum on credibility. Carney's background as a central banker gives him fluency in this language of markets. He understands that signaling discipline can anchor expectations, while erratic escalation can unmoor them. Conversely, the White House confronts the paradox of leverage in an interconnected system. The larger economy may possess greater absolute power, but it also bears greater exposure to systemic shock. Consider agriculture beyond dairy. Fertilizer inputs, potash, and grain logistics cross the border routinely, and any friction there compounds into grocery prices months later. Consider electricity grids in border regions that rely on coordinated energy flows. Consider defense supply chains, in which specialized components are sourced from facilities on both sides of the line. None of these sectors operates in isolation, and none can be surgically separated without cost. Political advisors in Washington must weigh the optics of appearing uncompromising against the tangible fallout in swing states where manufacturing employment remains both symbolically and economically central. Meanwhile, Canadian officials face their own domestic pressures, demonstrating resolve without triggering layoffs in export-dependent provinces, reassuring voters that sovereignty does not equate to self-inflicted harm. Internationally, allies are watching with quiet intensity. European policymakers see echoes of their own trade tensions with the United States in recent years and are evaluating whether closer coordination with Canada could mitigate exposure. Asian partners are calculating opportunities for expanded energy imports or strategic mineral partnerships should North American flows shift. Even global institutions that typically avoid overt commentary are tracking the dispute as a stress test of the rules-based trading order. The broader narrative emerging is one of recalibration. For decades, proximity and shared values insulated the US-Canada relationship from the kind of public brinkmanship more common in distant rivalries. Now that insulation appears thinner, the diplomatic language remains formally courteous, yet beneath it lies a contest over precedent, whether economic size grants the right to dictate terms, or whether integration imposes mutual constraint. Businesses crave predictability, and unpredictability carries a premium that consumers ultimately pay. If tariffs are enacted and retaliation follows, inflationary pressures could intensify at a moment when central banks are already navigating delicate post-pandemic adjustments. If compromise is reached, it may still leave scars in the form of revised contracts, diversification strategies, and political skepticism that endure long after headlines fade. In either case, the relationship will not simply revert to its prior state. Once vulnerabilities are revealed, they are incorporated into future planning. Governments may accelerate efforts to localize certain industries, diversify export markets, or embed new dispute resolution mechanisms into trade frameworks. Voters, observing the volatility, may reassess assumptions about the permanence of alliances. What began as a tactical confrontation over specific policy demands is evolving into a strategic inflection point about how interdependent democracies negotiate power in an era defined by instant communication and domestic political polarization. The immediate outcome remains uncertain, but the structural question is now unavoidable. Can two economies so deeply intertwined sustain a relationship increasingly defined by public ultimatums? Or will this episode compel a redesign of continental cooperation for a more contentious age? As officials on both sides retreat into strategy sessions and late-night calls with industry leaders, another dimension of this confrontation is coming into focus: the institutional strain. Trade agreements like the USMCA were designed not only to lower tariffs, but to provide mechanisms for dispute resolution precisely to prevent political theatrics from spilling into economic warfare. Panels, arbitration clauses, phased consultations, all of it exists to buy time and lower the temperature. The fact that threats were issued publicly before those mechanisms were fully exhausted suggests a shift away from institutional guardrails toward personality-driven brinkmanship. Trade lawyers in Washington and Ottawa are now parsing language, debating whether certain actions would violate specific chapters of the agreement, and quietly preparing for challenges that could take months or years to resolve. That timeline matters because uncertainty itself becomes a tax. When companies cannot predict regulatory conditions 6 months ahead, they hoard cash, delay expansion, and hedge currency exposure. That caution ripples outward into hiring decisions and capital expenditure plans. It is not dramatic enough to dominate headlines, but it quietly shapes growth trajectories. At the same time, provincial premiers and U.S. governors are beginning to assert themselves more visibly. Subnational leaders often feel the economic pain first, and their lobbying power can be significant. Governors in auto-heavy states understand that retaliatory measures targeting specific industries could quickly become local political crises. Canadian provincial leaders, particularly in energy-producing regions, must balance federal solidarity with regional economic interests. The longer the standoff continues, the more fragmented the domestic political landscape may become, complicating national negotiating positions. There is also the currency dimension. The US dollar's global reserve status offers insulation, but it also magnifies global reaction to American policy volatility. If investors begin pricing higher political risk into US assets relative to Canadian or European counterparts, even marginal capital flows can alter borrowing costs. Sovereign debt markets are sensitive ecosystems. Confidence shifts incrementally before they shift dramatically. Meanwhile, supply chain diversification, once discussed primarily in the context of China, may accelerate within North America itself. Corporations are pragmatic. If political risk between the US and Canada rises structurally, executives will examine Mexico, Europe, and Asia not as ideological statements, but as operational contingencies. Diversification is expensive up front, but it becomes rational insurance against repeated shocks. Over time, that insurance reshapes trade patterns in ways that are difficult to reverse. There is also a psychological turning point unfolding among the public. Generations grew up viewing the US-Canada relationship as uniquely stable, almost immune to the volatility that characterizes other geopolitical rivalries. That perception carried economic weight. Stability lowers transaction costs. When that perception erodes, even partially, it alters behavior. Businesses write more detailed contingency clauses. Investors demand higher returns to compensate for uncertainty. Citizens question assumptions about mobility, employment, and cross-border opportunity. None of this requires a formal rupture to have lasting impact. It requires only repeated reminders that stability is no longer guaranteed. Analysts who specialize in alliance politics note that fractures between close partners often begin not with dramatic separation, but with cumulative distrust. Each episode of confrontation adds a thin layer of caution. Eventually, cooperation persists, but it is more transactional, less instinctive. That appears to be the inflection underway. Whether leaders ultimately de-escalate or double down, the lesson absorbed by policymakers globally will be that economic interdependence is both shield and vulnerability. The United States retains enormous structural advantages: market size, military capacity, financial dominance, but those strengths are most effective when paired with predictability. Canada, smaller but strategically positioned, is leveraging targeted influence rather than raw scale. The outcome will hinge less on rhetoric and more on endurance. Which side can sustain economic discomfort without fracturing politically? Markets will continue to serve as the immediate scoreboard, but the deeper score will be measured in recalibrated supply chains, amended contracts, and altered expectations. Whatever resolution emerges, it is unlikely to restore the effortless confidence that once defined the relationship. Instead, a new equilibrium may form, more cautious, more conditional, and shaped by the recognition that even the closest alliances must now withstand the pressures of domestic politics amplified by global scrutiny.